I'm going ahead, yeah? So if there's any doubts or any questions, please don't hesitate to ask. As you can see, we're going to a little bit more complexity in terms of the case study for the QIF. Maybe you can't read it very well. I'll just go through the single issues. When you set up a QIF fund, there are certain aspects and characteristics which are quite important for investors and also for people who make the investments. The first thing is that it's exempt from Irish taxes on income and gains on the fund. So if the fund makes 100, because you invest at 50 and it goes to 100, the 50 is not taxed. Okay, so it remains tax-free within the fund. So these are effectively tax-free, transparent vehicles. The tax is paid on a client basis, so it depends where the client's based. So if your client's based in Italy and buys into your Irish fund, you will pay him 100, and then he is liable for tax where he's resident. If the end client, for example, lives in a low tax environment, so maybe in Dubai or could be in Switzerland, for example, he pays the local tax. So that means this vehicle is quite useful to get tax transparency and also be very tax efficient for the end client. So you can see that it's interesting for these sort of investors to invest into these sort of vehicles because all the profits generated are tax-free. As well, you'll find that there's no withholding taxes on income distributions and redemption payments, so it all goes out gross. So the Irish fund will not withhold Irish tax. This, however, you need to specify that the client is non-Irish resident. So this is an advantage for all non-Irish residents. So you set up the fund in Ireland, you sell it to an Italian investor, he will not have withholding tax in Ireland, he will get whatever tax he will pay in Italy. So he'll get Italian withholding tax, he'll pay a capital gains tax according to Italian law. A Brazil investor will pay everything in terms of Brazil. So there's no worries in terms of having different tax status or double taxation. As I mentioned, the tax status applies in the home jurisdiction of the investor. And then one of the main things with QIFs is that there's a very intense use of SPVs, of special purpose vehicles. And I'll explain why. But in this case, one of the things that you need to understand when you set up an Irish QIF fund, they tend to put, I'll just go ahead a little bit so you can see this is the umbrella structure. They tend to put below the fund an Irish SPV. An Irish SPV is a Company 110 structure from the Companies Act, which becomes necessary to be able to profit from the double taxation agreements that they have. Now currently Ireland has about 56 agreements worldwide in terms of double taxation. There are some countries, however, who do not have the double taxation agreement or do not really approve the fact that the Irish SPV pays less tax. Let me put this into perspective. I think you're all aware that corporate tax in Ireland is lower than you have in Italy, than you have in France, than you have in Germany. So the corporate tax is lower. An Irish SPV is effectively an Irish company. So the Irish SPV will be paying Irish corporate tax, which is a lower level. Now, that is accepted. That's accepted especially if there's a double taxation agreement between Ireland and Italy. And that's a justification to say, well, I've already paid the taxes in Ireland. Why should I be paying extra taxes in Italy? There's a double taxation agreement. So it's quite important. To make sure that the double taxation agreement is applied, you create an Irish SPV underneath that before doing the investments. In this case, the Irish SPVs are taxed at 25%. Okay? Initially taxed at 25%. But as we mentioned before, especially in Ireland, you can create tax-efficient vehicles. So what you tend to do is you tend to apply costs into the fund, and on the top you tend to provide profit participating loans. The profit participating loans feed money from the top to the bottom and then they get paid upwards. I'll show you on the graph. After the Irish SPVs, you create separate SPVs according to the location or jurisdiction of your investments. And we'll see that in the graph. It's just easier to understand. So this is the traditional structure for an umbrella QIF. As I mentioned before, underneath the umbrella you have separate funds. It can be an infinite amount. There's no limit in terms of the amounts of funds you can create underneath an umbrella. So basically you will have a prospectus for the umbrella. The prospectus of the umbrella will regulate in general all the rules or all the limits that you wish to put into the various sub-funds. Every sub-fund will have a single prospectus, which is usually easier. Therefore, the investor will read two prospectuses. He'll read the prospectus of the umbrella to understand how the umbrella works. Then he'll read the prospectus of the sub-fund to understand what the investment objectives are, what the investment strategies are, where are the areas of investment, where are the areas of development, geographic location, non-geographic location. It's not obligatory to have, because I told you the QIF structure is flexible, so you can put, I want to do sustainable investments on a worldwide basis. Fine. I want to do sustainable investments up to 500 million euros. Fine. You're not obliged to do that. It just helps the investor understand what your strategy is. So you're doing it to help the investor. When he reads your prospectus, it's a calling card for him to understand what strategy you're trying to adopt. Okay. So these are on the sub-fund basis. As I mentioned before, then you have the Irish SPV. This is an example in terms of being set up. It's not always necessary, but it is useful to set up so you have complete access to the double taxation treaties around the world, because they can't complain that the fund is a tax-effective vehicle if you're investing out of an Irish SPV. You can say, well, it's an Irish company. Therefore, it's Irish law. Therefore, I'm going to pay 25% here. Okay. I mentioned profit participation loans because you get the money coming in from the top. It usually gets moved down to the Irish SPV through a loan. And then it goes moved down, always further down into the individual investment, which will be the sustainable energy project investment. Which means that since it's a loan, the loan needs to be reimbursed. You have interest and you have capital. Therefore, the interest goes back up, the capital goes back up. As you can understand, these are tax deductible items. Certain countries have certain limits, but what it means is that the 25% here tends to get reduced. It goes into the fund tax-free. Okay, this is just to give you an understanding in terms of the mechanics to be used. So you can see the fund, the Irish SPV, investing into a local jurisdiction SPV. So for example, if we were to buy a plant in Italy, we would probably have an Italian company which holds the plant. So the fund will be buying shares in the Italian company which owns directly the investment. It's very difficult to do the direct investment from the fund. What I can say is that in terms of Irish QIPs, you cannot do real estate investments here. Direct investments are not permitted by law. It has to be done through an Irish SPV. Direct investments are permitted, for example, for sustainable energy. But then, the other thing that you need to remember is segregation of assets. We talked about the segregation of assets of the various sub-funds, and I think that that's quite clear in your minds in terms of the legal implications for that. But doing it through SPVs, you're actually separating your legal obligations for the single investment. So if this investment goes broke for whatever reason, goes belly up, the loss is contained in the SPV. It won't move into the other SPVs. This investment does not have to finance the other investment for the money. And people on this side are banks who have provided credit for that investment, because as you all know better than I do, when you invest in sustainable energy, you have projects which are full of debt, because there's a natural history of these sort of investments. If this were to go broke, they cannot do a recourse to the other investments within the fund. And that's one of the main purposes as well, is why you have the SPV. So if you have this sort of structure where you have an investment and then you have other investments, if this investment goes broke, it's a pooling of assets. Therefore, the banks can go into your other investments and ask back for the money. To avoid that, you do it in an SPV structure. And then this is another simplified version where you just do the sub-fund Irish SPV and the direct investment without using this SPV. But still, it can entail a certain pooling of assets on this level. So what you tend to see, especially when you set up these sort of vehicles, is the left side of the equation. Okay, just bear that in mind. Here I just wanted to show you who the parties are involved when you set up a fund. So if we start, it's another graphic representation. So you have the umbrella, it's the larger part of the circles. We saw that, that's on the top. Within the umbrella we have a sustainable energy fund, which is focused in terms of investment objective and strategies in terms of investing in sustainable energy. So who are the parties involved? You know, it's not just the fund manager. It's not just us in terms of Tendercapital who make investment decisions in terms of the fund. We are the investment manager at this point in time. Tendercapital is the investment manager of the Sustainable Energy Fund. What happens is that the investment manager either has resources in-house or uses an investment advisor, chooses, that will help them select investments. We'll do the due diligence, we'll do the screening of the investments. We'll present that in an investment committee, which is composed of people from the investment manager and usually somebody from the investment advisor, who will analyze all the data, which comes out from a data room, and they'll take the investment decision. Once the investment decision is done, it'll go into the fund. So as you can see, there's a committee process going on, and this sort of process will be more and more common as we go forward. So you won't have one fund manager deciding to do a single investment in a fund. Because what you need here in terms of the investment committee, you have an investment committee, you'll have the minutes of the investment committee, you'll have the reasons for the decision making, why the investment was done, what due diligence was done, everything will be written black and white. You need this for the so-called onshore structuring in Luxembourg and Ireland. You need to be able to justify 100% to your investors what you have done. Because all's well when things go well, but when things go wrong, this is what you have to have in place. They call it corporate governance. And this is an increasing importance in alternative investment space. And we'll see that with the AIFMD. On top of that, you have to understand there's other parties involved in terms of managing the fund. You'll have a custodian administrator. The custodian administrator is a very important figure in this entire process, because the custodian administrator are the ones that will hold the asset legally on your behalf. Legally on your behalf, they will also be monitoring and calculating the NAV for you, which is important. You'll have a NAV in this fund. It won't be a daily NAV. It will probably be a 6-monthly NAV, a yearly NAV, or a 3-monthly NAV. Yearly NAVs are usually not used anymore because it's too much of a time frame to go through. They will, and they're legally liable for the NAV that they produce. So it's quite important for them. You'll have to go through a huge due diligence process just to get the custodian and administrator on board your fund. You need to make sure that they're happy with this and that the corporate governance is there. On top of that, the investment manager will nominate an independent valuator for the fund. I can tell you from experience, as I said, this is all coming on the basis of what we've done over the past 6 or 7 months. And that makes the custodian and administrator happy. You'll see from the AIFMD, that is now becoming obligatory. You need to have an independent valuator for your asset at least once a year. That wasn't the case beforehand. You can have your own valuation within the fund. Now you can understand there could be conflicts of interest there. They've tried to remove that, and they are removing that with the IFMD. So as you can see, it's becoming a much more regulated market. That's why it's important for you guys to understand the process. On top of that, you have the normal legal and tax service providers. You know, we're talking about Deloitte and Touch, just to mention a couple of names. You'll have tax advisors across the world according to where the investment is actually done, because you need to understand, going back to the original graph, how the profit participating loan, which feeds the money from the top to the bottom, then gets paid up again. And what the rules and regulations are in terms of the deductibility of those taxes going forth. Every jurisdiction has a different way of looking at deductibility of the taxes. This is something for you guys to understand, because it all hit the bottom line. You think you've made 100, you haven't. You've made less. All right? That's something that Mr. Partley will go into detail so you can understand. Auditor, the auditor as well is very important. We talked about the independent auditors and external auditors. This ensures that the balance sheet of the funds are correct, because if you go into the complicated structure that we went into before, you need to have an auditor here, 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 and here. So usually you have a local auditor here, and then the international Irish auditor, international auditor. Just to understand that there's various parties that you guys need to be able to organize just to think about setting up a fund. Okay, we're coming to the end of the presentation. I think we have the last 2 slides, and here I want to dedicate a bit of time to the new Alternative Investment Managers Financial Directive, because this is quite important for you guys since we're looking at alternative investments. Now, they've done this for a series of reasons. They've done this mainly to protect investors. And they've done this to promote financial stability. The financial regulators across the world, especially in Europe, are worried about the excessive use of leverage, the non-adequate use of corporate governance within the funds, the non-correct analysis of risk, They want to make sure there's a process and a procedure in place in any fund which is created such that there's more protection for the investors. And the fact that there's a series of rules and regulations will help promote financial stability. So you don't get, you'll always have situations with projects which won't do well. But they want to make sure that the companies who invest in these sort of projects have gone down a due diligence route, which means that they've covered various angles. And I'll mention a couple of terms that you've already read in the newspapers recently, and you'll understand why they're going down this sort of route. So this was launched, this is the law of 2011. It will come into fruition in July 2013, so now. I think the effective date of application reception by the single EU locations is 22nd of July. And the 22nd of July should be received within the various countries. So they've been working hard. They've been working hard to transform the EU law into the local law. It's quite important. They've introduced what I call an alternative investment fund harmonized fund concept. So all the rules and regulations are harmonized. So everyone who creates an alternative fund needs to have a fixed set and a common set of rules across all the funds, be it private equity, venture capitalists, hedge funds, and so forth. Which is all important because you can understand that, and I put it here, you're looking at UCITS capital requirements now. So everything that you heard very briefly on the UCITS, which is another lesson in itself, will be transposed onto non-UCITS vehicles. So you're looking at minimum capital requirements of 100,000, minimum capital requirements of 125 for Luxembourg, and so forth. Usually when you look at onshore vehicles, the minimum limits are much higher. Now that we're on the onshore space, to protect investors and to promote financial stability, they want to promote a common set of rules. Which also means that they've created a new fund manager concept, the alternative investment fund manager concept. So it's not sufficient anymore just to be a fund manager and say, I'm a fund manager running hedge funds. No, you need to be an alternative investment fund manager. And to be an alternative investment fund manager, you need to reflect a series of rules, regulations, corporate governance behavior that we as regulators are comfortable with to ensure a whole series of aspects. I'll say that and I'll let you know what they are in the next slide. One of the main objectives of the fund and one of the functions that is promoted heavily in this directive is the depository function. So we go back to the custodian depository. I told you it's a very important service provider for the fund. They need to ensure a series of checks. They need to ensure an adequate cash flow monitoring. It seems stupid, but there's a lot of projects which are bought into by the funds which end up being cash strapped. So they do initial business plan calculations on the basis of future cash flows. It dries up. It dries up because of change of regulation. They've changed the subsidies which goes into the funds. All of a sudden you have a complete different new business plan. It's important for the depository to check this cash flow to make sure that funds don't go into cash liquidity issues, something which we've had in the past. A lot of funds have closed down, shut shop, have been closed, they've gone into side pockets to allow the disinvestments of the funds. Who's lost out in that? The investors of the fund. The investors have had to wait not 3 years, not 5 years, maybe 10 years before they start seeing pennies on the dollar. So it's quite important in terms of depository function. In fact, there's a big upheaval in all the depository space because they have a lot of responsibility, more than in the past. As I said before, they have to take care of the custody, so they become legal owners they usually become legal owners of the property, of the investment within the fund. They have to provide an oversight function, so it's a double check. It's very much reintroducing or putting a lot of emphasis in terms of trustee functions as well. The trustee will work on behalf of the investors of the fund. It's a separate independent person. So it's not yourself anymore. You need to deal with another series of people. You can think that the investment is a positive investment, but you need to get the stamp from the other service providers, and particularly the depository, who will ensure that you've answered a series of questions. So is the investment feasible? Does it have a sufficient cash flow? What is the time frame? Everything needs to be imagined. You just can't pick up the phone and say, I want to buy that project in Sicily or in North Italy because I think it's good. No, you need to go through a whole process. These above functions may not be delegated, so you need to have a custody. You need to have a depository who works for you. Okay, you can't delegate to someone else. It needs to be delegated just to the custodian, and they need to maintain those functions in-house. They can't delegate it to someone else. So they're big entities out there. Another important aspect, and we've seen that before, segregation of assets. They're insisting on segregation of assets because they want to avoid situations where an investment goes and cannibalizes other investments within the fund. So if you do one wrong investment, you shouldn't be punishing the other good investments. And so that's something they're insisting on as well. But we already saw that if you already set up the structure in a certain way with the SPVs, you have segregation of assets. So that's something just black and white. Valuations, as I mentioned before, now it's once a year minimum. So you need to have an independent valuator to do evaluation of your investments. You can have your own model. Your model has to be validated. Your model needs to be taken away, analyzed by someone independent who puts a stamp on saying he's done the analysis, and that will make the custodian happy. But now it's going to be a rule. And on top of the 1 year minimum, you may have to do it more times as required. Because if you have 3-month liquidity, to make sure the NAV is correct, you need to have an evaluation. So you'll come up with contracts, with valuators, which are on a yearly basis, which then have 3-month updates, 6-month updates, and so forth. Because if you're providing liquidity at a certain point in time, the NAV needs to be precise, because you can be responsible in the future for providing a NAV which wasn't correct. So you need to get the valuation done. As I mentioned before, independent valuators, very important. I think this is the final slide. Yeah. Okay, so obligations. As I mentioned before, it's nothing different compared to someone doing this with the correct corporate governance, but they wanted to put this black and white. They wanted to make sure that everyone does it. So they wanted to create common ground. So they're asking for certain transparency. They want to know on a 3-month basis what your holdings are. So what holdings do you have in? Have you put limits in the prospectus? Have these limits been verified and checked? Because it's a conflict of interest for the investment manager to do its own checks on its limits. It has to do it because it's good for internal policy and corporate policy. You just can't let other people do it. But you tend to delegate to other people risk management of limits. In this case, they're obliging the funds to provide reporting to the custodian to make sure that everything is in hand. Limits and holdings. Risk management. We talked about risk management before. They want to ensure that you have a risk management check process. So they want you to provide a risk management report. So who takes care of your risk? Is it done in-house? Is it done externally? What limits do they look at? What are they looking at? What frequency do the risk reports come out? Is it daily? Is it monthly? Is it weekly? It's a communication process between yourself and the other providers to understand what the right model is. If you have investments on a 5-year basis, you don't want to have a risk management function which is working every day. You want to have a risk management process which looks at your assets maybe once a month, which has a different cost structure compared to do it daily. So there's a series of things. Then when you go more into the future life cycle of the project, you'll probably get in your risk management more on a daily basis because you'll be managing liquidity more than investments. You'll be selling your investments, you'll be holding liquidity. The liquidity then needs to get paid to the shareholders. And therefore your risk management system needs to be beefed up to go daily. Organization. This has been in the press for the past months. They want to know who the risk takers are. They want to know not only who the CEO is, who's the ultimate responsible person in the company, especially the investment manager, because the investment manager makes the investment decisions. If something goes wrong, the blame is given to the investment manager. The investment manager will blame the CEO, who's head of the company. That's not enough for the regulator now. They want to know who within the investment manager is actually the risk taker. They want to be able to identify future culprits of any disasters which will happen. So you need to make it very clear within your structure who's taking the decisions. On top of that, they want you to illustrate remuneration policies within your structure. They want to know how the risk takers are remunerated. Do you give them a fixed salary and that's it? He goes home. Do you give him a variable part of the salary as well? What is the variable based on? They want to know everything because they want to ensure that, as I mentioned before, when things go well, no one complains, everything is smooth sailing. When things go wrong, they want to have the possibility to go back with their documents and say, okay, we know who was working there. We know who all the senior management people were. We know who all the risk takers are, so we know who to attribute blame to. So as you see, it's a much more structural process than before. So it puts a lot of responsibility on a whole series of people. All the people we saw in the diagram have now increased responsibilities because it's become a regulated space from the next 2 weeks. Which, as I mentioned before, it's positive for the investors because you're there to protect investor stability, financial stability in the markets. You can delegate responsibilities, that's permitted. You just need to have a whole list in terms of who you delegate what to who. So you can delegate risk outside, and usually it's easier unless you want to create a big structure. You want to focus, I mean, I probably scared you guys in terms of the whole complexity of the organization. You want to be able to focus on making the investments. You want to be able to focus on doing your business plans, analyzing the project, looking at the lifestyle of the project, doing the investments, following that. That's the exciting part of the business. Doesn't mean you can forget the rest, but you can start delegating to external agencies. You can delegate risk, and sometimes you get big organizations who dedicate 1, 2 people to your structure, so you don't need to have someone internally within your structure. You can delegate compliance. You can delegate human resources, remuneration. You can delegate the provision of code of conduct within the firm. So there's a whole series of functions you delegate, so you can concentrate on administrating on a top-down basis and doing the investments. So it's not scary, but remember, we're going into an outsourced model for a lot of the functions. Something which is very much used in the US, very much used in Anglo-Saxon countries, in Luxembourg as well. Italy is slowly starting to go in that general direction. Okay. The other important point for the AFMD is marketing, especially for EU alternative investment funds. Now, they're making a distinction between offshore and onshore AIFs. So, to give you an example, if an offshore AIF comes into Europe, they have strict rules and regulations about what they can market. It's called private placement. So they cannot solicit business, they cannot solicit phone calls, they cannot publicize, they cannot advertise their products. And so they're not limited, there's a series of limitations they need to go through before they can actually speak to an investor. The investor needs to be institutional. Usually the investor needs to confirm an appointment or make the appointment themselves to see the fund manager. With the EU alternative investment funds, they've targeted a procedure very similar to the UCITS. They want the AIFs to be authorized by every single country as a UCITS fund. So you get authorization from your home regulator, and from the home regulator you ask for authorization and distribution of this product across Europe. That's UCITS. Of course, you're not going to be able to market to retail. It's always going to be professional investors. They always want to make sure that the target is still high because, you know, high risk, high reward. You don't want to have issues in terms of the retail. You don't want to have any issues in terms of incomprehension of prospectuses, conditions, risk, and so forth. All right. So there is the possibility to market these funds across Europe in respect of the directive. The private placement rule for EU AIFs will no longer be valid. If you want to market in Germany and you have an Irish fund, you need to ask for authorization in Ireland to get your fund authorized to market in Europe. They will not be allowing private placement, which is what is done now, currently. And they'll give you 6 years for other funds to be in line. So if you don't accept the IFMD now, you have a 6-year grace process for private placement. After that, forget about it. Either you apply to be an IFMD or you don't. So this is something that I suggest you guys look at when it comes out, especially when it's received, for example, from the Italian authorities, regulatory authorities, or the Irish authorities. It's an important directive for you because it does change the way that you look at doing investments across Europe and the effect it will have on the funds and the due diligence you need to do. I understand it's a lot more work, and in fact our workload has multiplied exponentially, but it's a necessary evil to have in terms of protecting the investors and ensuring that there's financial stability within the regulated markets across Europe. And here I will stop. If there's any questions, I'll take them. Otherwise, we can ask Mr. Paridi to come up.
I have a question.
Yeah.
About the sustainable energy fund that you were showing the picture. Which kind of project are you involved? I mean, renewable energy or conventional energy with...
You'll see this, Mr. Paridi will illustrate the various subsectors that we go invest in. I took the general concept in terms of sustainable energy. He'll go down more into the detail in terms of the kind of sub-strategies of investments that we do. And there's quite a very vast range in terms of sustainable energy we do. Every year there's a new alternative energy technology. You go from alternative energy space to energy efficiency savings. That's also becoming an integral part of investing in sustainable energy. So you can invest in solar, wind, biomass, and so forth. On top of that, you can invest in technologies which increase the efficiency of such. That is also an investable asset within the funds. But he'll go more into detail so you understand how that works. I wanted to give you guys a framework that you understand in terms of working around and what you're going to get you guys into over the next years.
And may I ask you,
Yeah, please.
Is energy now a sector that is that you find interesting, or there are other sectors, let's say, in the whole market that are appealing for your company, for venture capital?
We find the energy sector is always quite interesting because it's very dynamic. We're moving, and Mr. Pardi will go more into detail, we're moving into different spaces. I mean, I think we've moved from subsidized models to models which generate electricity at the same price as conventional energy. So you're looking at more commodity companies. So your whole business model will change at a certain point. The new alternative energy technologies will produce electricity at the same level as other energy providers, and that means they need to work out as commodity companies. You'll have new technologies coming in that have to be analyzed. Will they be subject to subsidies or not? I think the governments are reducing the subsidy because it's a huge weight on the balance sheet, even though going green is quite important. So it's an interesting space to look at. One of the aspects as well, which we're doing, at least in terms of Tendercapital, is that we're looking at providing liquidity for the alternative investment space. So a lot of these projects are starting with a high level of debt, reduced by the cash flows that come in, but they want to be traded in or sold to other investors for the cash flow so the banks get their credit back. And that is creating a new market at the moment in terms of change in hands in terms of these alternative energy projects. You'll still have new energy projects. You'll have the greenfield, you'll have the brownfield, the authorized. Now we're getting the secondary market coming through in terms of funds investing for cash flows. You're not going to get your 20-30% returns, you'll get your 10% returns. But in this low interest rate environment, it's the kind of returns that people are looking to get into, which is quite important. When interest rates start rising, these sort of investments are usually inflation hedges because they're asset based. So in that point, it'll always be an interesting sector to be in. Definitely so.